Um, hi, my name's Annika. I use she, her pronouns, and I am the College 10 FIA for the Co-Curricular Programs Office in College 10. This is a part of my three-part series for life after college, where I really wanted to prepare students for life after undergrad, which is a long life, hopefully and very fulfilling, but I also wanted to have students become prepared for that journey. And so this is the second part with Tiffany, a great guest, and I'm really happy she was able to do this. She's an anthropology undergrad, as well as a Bay Federal Credit Union employee. So she's very experienced and has a lot of knowledge about money and how to build credit specifically for this event. Yeah, I'm really happy to have her. And if you have any questions, please do write them in the chat box and we will be checking throughout the event. And yeah, thank you so much, Tiffany, for joining.
Absolutely. Thank you for inviting me. And welcome to everybody. My name is Tiffany Zachmeier. Yes, I am an undergrad because, well, I did things a little backwards. And I came to school after I started my career and had my family. And I'm really glad that I did because I love UCSC and I love anthropology. It's amazing. So today we're going to be talking about good credit. And let's start with this. Hopefully everybody can see this. So make sure that this is going to work. There we go. Okay, so we're going to talk about a few different things today. First of all, what credit actually is, how it helps and hurts us, how it affects our lives, and then how to build, repair, and maintain it. We're also going to talk a little bit about how Q&A throughout the presentation. So if you do have a question, please use the chat box. Type in your question, and I will stop every once in a while and ask Ashley for those questions. Oh, and whomever is, can somebody mute? There we go. Okay. So what exactly is credit? Well, credit is a number of different things. Let's see, who's not muted right now? Okay, I'm going to keep going. So credit means a number of different things. It is a measurement of financial risk and responsibility, and it's expressed in credit reports and credit scores to make decisions about you. So credit begins with credit activities. So what I mean by credit activities are when you apply for a loan, or when your loan is approved, or when you have a credit card, or you forget to make a credit card payment. All of these things are considered credit activities. When these happen, they are sent by whomever you do those credit activities with, usually a credit union or a bank. Your credit union or bank sends those credit activities once a month to 3 credit bureaus: Experian, Equifax, and TransUnion. You may have heard about these credit bureaus. They are the ones that are responsible for holding on to all of our credit information and storing them up in what's called a credit report. And each credit bureau collects 7 to 10 years of information about you, stores it in a credit report, and each of them has their own, and makes that information available in certain circumstances. So what is in a credit report? Well, a lot of different things. Anything you would put on a credit application is going to be on your report. Your employers from the last 7 years, and of course, information about any loans or credit cards you may have, when you applied for them, how long they've been owed. Also, unpaid debts. may appear on your credit report. What I mean by an unpaid debt is something that you weren't able to repay, and the place you owed money to turned your account over to a collection agency, and they continue to collect the debt. Another type of unpaid debt might be a bankruptcy or a tax lien or child support payments. Rent and monthly income is sometimes on your credit report. So here are a few things that are not there. Cell phone, utilities, and medical bills. Now, let me explain this a little bit. So medical bills can pop onto your credit report, but not until they remain unpaid for a certain period of time. There are new laws, and you have a certain amount of time to work out your medical bill payments with whomever you owe them to before they can be sold off to a collection agency. So you have more leeway there. Cell phone and utility bills only appear on your credit report if you haven't paid them. So I've heard people say to me, oh yeah, I know I have great credit because I pay my cell phone bill every month. Well, that's not going to really do you any good. What does do you some good is checking investment accounts and non reports, criminal record, U.S. residency. Those are not on your credit report either. So credit reports are the starting place for your credit scores. So credit score is a number between 300 and 850. And the way credit scores work is the higher your score, the better your credit is considered to be. And the scores are calculated from information on your credit report. And let me show you how that works. So we started out with credit activities. Remember those applying for the loan and getting the loan and charging something. So those activities are sent once a month to credit bureaus, stored in your credit report. And then when someone asks to see that information or asks to see a credit score, the activities in the credit report can be used to calculate a score. Now, just like you have 3 credit reports, you also have at least 3 credit scores. And they're all calculated a little bit differently. So let's go back a little bit. So credit scores are based on credit reports, and they provide a snapshot of what is happening in your credit right now, because they can change from month to month. Every time a creditor sends information about you to those credit bureaus, that information could be a little bit different. You could owe a little less on a credit card, or you could have made a few more payments on time. And that affects your credit report and your credit score. I'll explain what that looks like. Credit reports have 7 to 10 years of your credit activities and your information. And both of these can be used to make certain decisions about you. Now, what kind of decisions are those? Well, scores and reports measure are a gauge of future risk based on, if I can speak, then that will help, I know, okay, based on past behavior. So the types of decisions that people are going to make when they have your credit information have a lot to do with applications and money. So I'll give you some examples. So lenders, if you apply for a loan or credit card at a credit union or a bank, lenders are going to use your credit score to decide how much interest they're going to charge you on your loan. They're also going to use your information in your credit report to determine how much money they might lend you, and also if they're even going to approve your application. Because sometimes, usually with loans and credit cards, lenders do not use just a credit score alone. They use the credit score and the credit report together to decide if they're going to loan you money. Now, that's not necessarily the case with other places. So utility and service companies, they actually use a modified version of your credit score to decide perhaps if they're going to allow you to start new service without a deposit. So a little story for you. So I am a bonus mom. I have bonus children. They're actually stepchildren, but I can't call them that because I won't be a stepmother, because Disney has done all kinds of terrible things to that. So my bonus daughter, Kelly, was moving up to San Francisco a couple of years ago, and she and her friends had gotten a really cool apartment, and she called me in tears and said, I don't know what I'm going to do. They want to charge me $400 to turn on the water. And it turns out Kelly and her friends didn't have any credit information. They had never had a loan. They had never made a payment on a loan, so there were no credit activities to create a credit report or a score. And so the utility company, the water company, said to them, okay, we don't know, based on the information that we would normally find in a credit score or report, whether or not you are likely to make payments, because we don't know if you've ever made any payments at all. So, because we don't know, we want $400 as a security deposit, and if you pay all your bills on time for an entire year, you'll get it back. If you don't, then we're going to hang on to it. So that was a little difficult for us. So that's what can happen. So insurance companies also use your credit information. In fact, if you have good credit, then you're going to pay less for your auto insurance. There is a study that shows that people who have good credit file fewer claims with their insurance company. So when you file a claim with the insurance company for auto insurance, you're probably saying, I got into an accident and I need you to pay to fix things. Well, people with good credit tend to do that less. They cost the company less. And so the insurance company is going to reward you with lower insurance premiums. Landlords also. So if you've ever filled out an application for an apartment, you've signed something that probably said, I give my permission for you to check on my credit information. Now, landlords use credit information because they want to see if you make your payments on things on time. Because if you're paying your bills on time, you're probably going to be the kind of person who pays your rent on time. And that's the kind of person they want. Also, employers use your credit information as well. Not usually your credit score, but your credit report. So your credit report shows things like how responsible you've been with loans and credit cards, if you're paying them on time, how much you owe, things like that. And so employers are looking at that to determine if they think you're a responsible type of person. And your credit report information can be used in their decision to hire you or not. Now, they're supposed to tell you if they use that information. I don't know that all of them do, but I can tell you that over 75% of employers use credit information in hiring decisions. So it's really important to make sure that your credit is good. So these are all things that I just went over: benefits of good credit and consequences of no credit or bad credit. I'm going to find some way of making this presentation available to you so that you can see it, and in case you miss anything. So if you miss anything now or you want to remember anything later, it'll be available to you. Here's some important details about credit scores and credit reports. So first of all, let's do a question. I received a question from somebody in the audience today beforehand, and I wanted to address it at this point. So the question was a three-part. Does everyone start with a good credit score? If you've never been late on a credit payment or had any debt, can you assume you have a good credit score, or do you just not have a score at all? You don't have a score. You start out without a score, without a credit record at all. The score does not happen until you have some sort of credit activity that is being sent over to credit bureaus to be saved in your credit report. Once you have something in there, then you're going to generate a score, but it's not going to be a good one. It's going to be a low one because you're just starting out. I want to show you what has to happen to help you build a score, and what different components make up that score and how they all work together. So your credit scores, all of them from all the credit bureaus, are calculated based on 5 areas of your credit report, and they're weighted a little bit differently. So the first one is new credit. That accounts for 10% of your credit score. And this looks at new credit applications. Now, when you apply for a loan or a credit card, your credit score and credit report see that as an automatic negative. It means you may not have the money that you need to pay for something. And so you're applying to borrow money so that you can do something you might not otherwise do. A new credit application is likely going to always drop your score by a few points, at least. So you have to be careful and not apply for a lot of credit all the time. The good thing about new credit applications, they're also called inquiries. They're because the lender that you're applying with is kind of reaching in and looking at, getting your permission and reaching in and pulling out credit information. That only lasts on your credit report for about 2 years, and then it'll fall off. So here's another part. Your credit mix, that's also 10%. Now, credit mix is the different types of loans and credit cards that you have or that you've had within the past 7 to 10 years. And different types of loans have different effects on your credit report and your credit score. I'll show you that, a little bit about that in just a minute. Length of credit history. The longer your credit history is, the better it is likely to be. So if you start building credit right now, then you have a longer period of time to build it up and create those credit activities that are really going to help you build up your good credit. Amounts owed. Now this covers a couple different areas. I will show you how maxed out credit cards can lower your scores. But if you owe money on a credit card, it means something different than if you owe money on a mortgage, a home loan, or a student loan. If you have $25,000 in student loans, it's actually going to look really good on your credit report, and it's going to reflect well on your credit score. It can actually boost your credit score. However, that same $25,000, if it's owed on a credit card, it's a little bit different. It is going to actually reduce your score.
I have a question.
Yes.
Why is it that the student loans actually make your credit score look good?
There are different type of loan. I'll get into that in just a second. The next slide actually has some information about that. Give me just a second. Okay, here's the last one. Payment history. If there's nothing else you get out of today, always make your payments on time. Making on-time payments by the due date is the best way you can build good credit. Okay, so here's where we get into why different loans and mean different things to your credit report, and how amounts owed, one amount owed on one type of loan can be good, and the same amount on a different kind of loan can be bad. So let's look at the student loan column and the credit card column. For student loans, right in the middle. So this type of loan means you borrow money to go to school to improve your chances of getting a higher paying job. And that is seen as a positive thing. Now, it's also a positive on your credit report that if you don't pay those loans, the government can come and get the payments from you. So there's some guarantee on that loan that you're going to pay it back. And so the risk of you not paying it back is kind of medium to low. So it can actually help your credit report and your credit score. If you owe a lot on student loans, though, it can interfere with your ability to get approved for loans and credit cards, because if you have very high minimum payments, those may cause concern with a lender. So if you have an $800 monthly payment on a student loan and you're applying for a home loan that is a couple $1,000s, your lender's probably going to look at that minimum payment on your student loans and be kind of concerned that that could interfere with your payment on your home loan. So student loans can help, but it can also hurt. Okay, so $25,000 on a student loan is actually good. $25,000 on a credit card, not so good. So what a credit card debt means is that you didn't have enough of your own money to buy something, and the lender can't do anything about it if you don't pay. They could take you to court, and that costs money, but really they can't go and repossess what you've purchased, and there's no guarantee that you're going to pay them back. So these are high risk loans, and owing that much on a credit card is more likely to decrease your score. Does that make sense? It's a little difficult to explain. I hope I made it a little bit clearer though. Some loans are good loans, good debt. You may have heard that. Student loans and mortgage loans tend to be good debt. Credit card debt, not so good. Okay, let's move on. So let me show you a little bit about how credit cards can affect your credit scores. So when you have a credit card and let's say you apply for your first card. So right off the bat, your application is going to be a negative on your credit score, but only for a couple of years. And you may need that credit card to start building your credit score and your report. So the moment you get that card, the length of credit history clock starts ticking. So you actually can start building, whoops, my mother's phone is ringing. Let's end that, if I can. And of course I can't. So we're gonna have to listen to it ring. Sorry about that. So credit mix. Now, a new credit card on its own can start building your credit history and your credit report. But if you have a student loan as well, then you've started to build your credit mix, which can reflect favorably on your report and your score. As long as you're making those monthly payments on your card, that's really going to add to your building of good credit. Here's where credit cards get a little dicey. So when you owe money on a card, you want to make sure that your balances, the amount you owe, are less than 30% of what you could owe. So your balance should be less than 30% of your credit limit. Let me show you what that looks like. So this is how it's all wrapped together. Okay, so let's say we have, whoops, how do I back that up? Hold on. Let me back up one.
There's a question. I don't know if you're able to answer it.
Yeah.
Megan?
Yeah, I had a quick question. I don't know if you're going to answer it later, but
yeah.
I know, like with my parents and stuff, like I have a credit card that I've been using to try to build my credit. They always tell me that I should pay like a certain percentage above the minimum every time. If I can't pay the full thing, at least like not near the minimum, like quite much more than that. I was wondering if there's like a good rule of thumb for that, of like how much you should be paying per month.
Aha, that's a really good question. You know what? Keep that And we'll get to that a little bit later, but yeah, that's an excellent question. Okay, and I have a really fun calculator to show you that I'll show you why that matters. Okay, so let's say you have 3 credit cards. You have a Visa card, you have a MasterCard, and you have a Discover card. Now, your Visa card has a credit limit of $5,000. Can you guys see that? $5,000 is your limit, but you owe $500 on it. That means if you take what you owe divided by your credit limit, it's going to give you your percent of your credit limit. So this Visa card, you owe 10% of your credit limit. That's not bad. MasterCard, you owe 30% of your credit limit. That's on the edge. That's probably going to drive your credit score up a little bit. And your Discover card has a 20%, is 20% of your credit limit. Now, here's what people sometimes do, and this is a common credit card mistake. Let's say we're looking at this Visa card and it's got a high interest rate and we really don't want it anymore because we're paying too much interest. So what we're going to do is we're going to close it. And we're going to transfer the balance to the MasterCard. Here's what happens. The MasterCard is now, you owe $800 on it. It's only got a $1,000 credit limit. So suddenly that ratio is off. You borrowed 80% of your credit limit. And that is going to drive your credit score down. Always make sure that what you owe on credit cards is less than 30% of what you could owe. Got it? I hope this is making sense. Please say it does. Anyway, let's move on. So here's something about credit scores that's a little weird. Credit scores don't tell the whole story. And I'm going to tell you a little story about what happened to my husband, Bill. So Bill got a hold of a credit score and he said, and it was 756. And he was like, okay, I have a 756 credit score. That's really great. I'm going to go apply for a loan. So he applies for a loan and it gets denied. And he was really confused because usually a person with a 756 credit score is more likely to get approved for loans and credit cards. That score shows that he's been responsible with credit in the past, and so he's probably going to be responsible for credit in the future. That score doesn't tell us is what's in the credit report. Now, in this case, there was a mistake on Bill's credit report. Somebody had a collection account of $4,000 that found its way onto Bill's credit report. He didn't know it. It dropped his credit score from what it would have been, but it wasn't enough for him to alarm him. And so when he saw that credit score of 756, he thought everything was okay. It wasn't until he applied for the loan and the lender looked at his score and his credit report that this came up. Now, when this happens, this can interfere with your ability to get loans and credit cards, but it can also interfere with your life. Because if a landlord sees that you owe $4,000 to a collection agency, even if that isn't yours, if it's on your credit report, it appears as if it's yours. And they might not rent an apartment to you. You might lose out on a job opportunity. So the thing that you want to do is make sure that all the information on your credit report is okay. I will show you how to do that in a minute. So here's another thing about credit scores. You have a lot of them. So Experian, Equifax, and TransUnion, they start out with their basic scores. And they're all about a number between about 300 and 850. But credit scores are a moneymaker. They actually sell them. So they've figured out a way to create hybrid scores that tell different companies different information. So they have a special credit score for insurance companies to help insurance companies decide how much they're going to charge you for your auto insurance. And they have special credit scores for people who are trying to buy a home to see how likely they are to file for bankruptcy. And so you have actually about 25 credit scores. The thing is, we don't know what credit scores are being used to make decisions about us. And so when people say, oh yeah, I've got a great credit score, well, which one? And does it matter? Because you could have a really great FICO score, but if your Pinnacle score is terrible, it could interfere with the decision. Now, since we don't know which score will be used for a decision, we have to make sure that where that score is coming from is the best it can be. And that's why we want to make sure that our credit reports are accurate at all times. When they are, they give us the best chance of having a positive outcome when a decision is made based on our credit. The place to check your credit reports is called annualcreditreport.com. This is the only website that is authorized by the federal government to offer you one free credit report per credit bureau every 12 months. So you could go in there today and see all of your credit reports, and then in 12 months, you can do it again for free. I highly recommend that you start taking a look at your credit reports. Even if you don't think you have any information on your credit report, it's a good idea to look at it anyway, because there are situations where you may not know that there's a mistake, like my husband Bill experienced that $4,000 on the $4,000 collection item. He didn't know about that. I have another story too, which was really sad. A few years ago, I got a call from a high school senior who had applied for a student loan, and he had been turned down. And it turned out that about 5 years before, someone had gone into his doctor's office and paid the receptionist to turn over a bunch of medical records. And that person stole the student's information and applied for a loan for a car and then never repaid it. So this student started out thinking they had no credit at all, and they actually started out with bad credit. And he had to go back and go into and communicate with the credit reporting agency and the original lender and make sure that that mistake was taken care of so he could get his student loan, so he could go to school. This happens a lot. Most of the time, when a minor's credit information is stolen and used to apply for credit, usually it's a family member. There are tons of cases where a parent or a sibling or an aunt or an uncle will steal a child's information, apply for a loan, and that child grows up and then finds out about what has happened. So make sure that you are looking at your credit information. Okay, so since the credit report is really the most important thing, should you monitor your credit scores? And my answer is yes, because it's fun. It's actually a good motivator. So if you see a credit score, it may not be a credit score that really matters for an important decision, but it's something to go on, and it can help you. It can help you get motivated to improve your credit score. And also, if you keep track of a credit score and you notice that it suddenly goes down dramatically, that could be a sign that somebody has stolen your information and applied for a loan without your knowledge. It could also mean there's some sort of mistake on your credit report that you need to look into. And so it can help you monitor those things. Let me show you, though, how different credit scores can be. So, let's see. So limit sharing your social security number on mobile apps. So there's this one, this gets into my next slide actually. So there are a bunch of different places you can get a credit score. One of them is you may already have. If you have a credit card, it is likely that somewhere on your mobile app for that credit card, there is a credit score. And it's available to you all the time. It could also have some credit report information. So that could really help you. You can also ask for your score if you are applying for a loan. If you are approved for that loan or denied that loan, that lender has to give you whatever credit information you ask for. You can also use a credit monitoring app. Experian has one, Credit Karma has one. The thing that I want to warn you about is limit the number of places that have your social security number. The more places that you enter your social security number, the more places that you could be vulnerable to fraud. And when somebody steals your information, it can take a very long time to clear things up. Of course, credit scores are also a moneymaker, so you can buy them, but why buy them when you can get them for free? So let me show you how different some scores are. So this is my score today on, I have a Discover card. And so I went on my app and took this picture. So this was taken at, let's see, 3:07 p.m. today. The score is 840. And as you can see, I don't know if you can see this. So underneath the score, it says I have a total of 7 accounts. Now, those are open credit cards, loans, and closed ones too. They're the 7 accounts that appear from the last 7 years. My length of credit history is, yes, in fact, 24 years. And that gives me an advantage because I've had credit for so long. My credit score is going to be really good. Down at the bottom, missed payments, 0 is what you want to see. Missing a payment can really hurt your credit, and make those payments on time. Also, up a little bit under the length of credit history where it says inquiries. An inquiry is when you apply for something and somebody looks at your credit information. Revolving utilization is a term used to describe how often you're using your credit cards. And actually using your credit cards and paying them off can help you build your credit, because it's showing that, yes, you're using your credit, but also you're making payments on time. So 3 minutes later, I pulled this one. This is from the Experian app. And notice that, so this is 3 minutes apart. And these are both FICO scores. They're both produced by Experian, but they're 10 points different. That makes no sense. What it tells us, though, is the credit score, there are lots of different credit scores. And since we don't know which one is going to be used to make a decision about us, let's make sure the credit report looks good. And we can look at the credit score every once in a while. Make sense?
Yeah. Hey, Tiffany, we have a question. Do you want to answer it now or save it for later?
What is it?
Right, so it says, I've heard before that you should always carry a little bit of your credit card balance unpaid each month. Like, for example, don't pay it off completely even if you are able to. Supposedly this will help build credit. Is this true, or should you always pay off your balance completely?
That's a wonderful question about a common myth. So a lot of things are affected by our credit scores and reports, but we do not have to necessarily pay money to build good credit. So people used to think that to build credit, you use your credit card, you buy something that's $100 and you pay it off in $25 increments over 4 months, and that's going to help you build credit. Actually, it's not the best way to, because when you do that, every month you're going to be charged an interest fee. So that $100 purchase is going to cost $100 plus interest. And that doesn't make sense when you don't have to do it. Actually, what you ought to do is if you really want to build good credit and stay out of trouble with credit cards, buy one thing a month, wait till you get the bill, and pay off the entire bill. You will not pay any interest, and you will get that on-time payment credit that builds up your credit score the fastest. Does that make sense? I'll take that as a yes. Okay, so now Megan, tell me your question again.
Mine was about if there's like, if you, let's say you can't pay off like your entire amount, but like I've been told you shouldn't pay the minimum either, because yeah, then you're just basically paying interest. So like, is there like a good sweet spot of how much you should pay that like looks better?
Okay, so the name of the game with credit cards is, if you owe money on credit cards, pay it off as soon as possible. If you, let's see, let me get a calculator that can show you what this is all about. Let's see. I think it's this one. Let me pop from here over to another screen and show you something about credit cards. So this is a website called dinkytown.net. It's a really weird name, but it's got great financial calculators. So let's say we have, let's do, I know what we can do. So a couple of years ago, my daughter blew out her tires. She hit something in the road, and her tires ended up costing her $600. So let's say we charge $600. Let me get rid of some of this. Let's say we charge $600 on this credit card. Now, interest rates vary. When you apply for a credit card, depending upon what your credit score is that the lender is using, your credit score is going to affect the interest rate that you pay. Now, generally speaking, the better your credit, so the higher your credit score, the lower your interest rate is going to be. So median rate for a credit card right now is around probably 18%. So we'll put 18% in there. And with credit cards, usually the minimum payment for a credit card is about 4%. So if we have a $600 balance and we find, let's see, that's about $24. So do that. So if we, now what we're looking at is a report. It says if we owe a total of $600 and we pay a minimum of $24, it's going to take us 5 years and 8 months to pay off this money, and we're going to be paying $276 in interest. Okay, so in my daughter's case, she bought those $600 tires plus $276 of interest. She ends up paying $876 for a set of $600 tires. Not such a great deal. So let's say we add some additional money up here. Let's say we add $20 a month. Now what this says is, now instead of 5 years and 8 months to pay this off, it's going to take us 1 year and 4 months to pay it off. And by adding an extra $20 a month, we're going to pay $199 less in interest. Megan, does that make sense? Let's unmute you. Does that make sense?
It does make sense. I think my biggest thing is finding the balance between paying off things fully and then also making sure I have enough money in my savings.
Yes.
That's like a really hard balance for me right now.
It really, really is. It's very hard to do this. What I'm not talking to you about today is budgeting. And when you have a budget that shows you exactly how much money you have coming in every month and how much money you need to pay your bills and what's, and how much you have left over, then it's easier. It makes it easier to make decisions about how much more you can pay on your credit card. So I'll give you a resource at the end that that you can use to learn more about budgeting. I'll also give you a link to dinkytown.net. It's got some great other financial calculators, including budget calculators. So you can kind of figure out how much more you can pay on that credit card so you can save money on that interest. Because the more you pay, the more you're going to save on interest payments every month. Okay, so let's go back to, I think we're doing okay right now. Let's go back to the presentation. Okay. All right, so here's how your credit scores can help you save money. So this is one way. So let's say, when your credit score and your credit report are saying all good things about you, you don't have a lot of debt, you make your payments on time, and you have a good credit score and credit report, then you are more likely to get a lower interest rate on a loan. Now, here's why. Interest is a fee that you pay for borrowing somebody else's money. And if you have a good credit score and a positive credit report, it means that the information in there shows that you can make payments on time. When lenders see that information and that you can make payments on time, you're going to be seen as less risky to them. And what I mean by risk is they see that you're going to make payments because you've done it in the past, so you're very likely to do it in the future. And because you make your payments on time, they're not going to have to send you letters and call you on the phone and try to get you to make a payment. All of that stuff, when they try and collect late payments, that costs them money. If they think they're not going to have to do that, they're going to charge you less up front. So let's say you want to buy a car and you borrow $15,000 and your loan is for 5 years. So if you have, a 625 credit score, it's not bad. It's not fantastic. It's just kind of in the middle. When you have a 625 credit, it's also called a C credit. And it may mean that you haven't had credit for very long, or you don't have a good credit mix. You might have a credit card and a student loan, and that's it. Or it could mean that you owe a little bit too much on your credit card. Whatever it is, if your credit score is 625, your interest rate is going to be a little higher than, say, somebody with a 695 score. So this is a little comparison here. And these are actual rates that I pulled today off the Bay Federal Credit Union website. So the 625 score person has an interest rate of 8.99%. But 70 points higher on that credit score, and the interest rate drops to 4.24%. Now, where you can really see that, of course, you can see the difference in the monthly payment. C credit gets you a $289 monthly payment, whereas B gets you $255. That's not a ton, but when you get to the interest you pay over 5 years, that's a considerable amount of money. C credit is paying $4,668, and the B credit person is paying a lot less. In fact, they're saving over $2,000 by having a higher credit score. Now, here's another one. Here is an A credit. It drops a little bit more, and you can see the difference. But this is one way that a credit score and a credit report can save you money. The credit information in your credit report is going to help you get approved for the loan. And the credit score is going to help the lender figure out a price that you'll pay for borrowing the money. Now, as you can see at the bottom, this is from that website, dinkytown.net. And I'll provide that to you at the end. Questions on this? Do y'all get that having good credit really makes a difference? And it's not only for getting loans. It's really about, unfortunately, credit is one of those things that we have very little control over, except for what we do. But it's used so many places, and we can't stop that. The credit is going to be used by landlords. It's going to be used by employers. And yes, it's going to be used by lenders. And we cannot do anything about that, about them using that, about them seeing our information, because that's the way the system is set up right now. When you know how this all works, though, you can make these systems work for you so that you can improve your ability to get the things that you need. So, there are some really good ways to build good credit and maintain that good credit, and also repair credit. See, sometimes people will make a mistake. They'll charge too much on their credit card, or they'll accidentally miss a payment. That information is going to affect your credit report for a while, but because credit reports only generally hold on to information for about 7 years, eventually it's going to drop off. So if you make some major mistakes with credit, don't worry about it. If you follow these next rules of good credit, you can repair that and build back good credit or build brand new credit. Okay, so here we go. Number one, always, always, always pay bills on time. And if you can't, call and ask for help. So sometimes in our lives, we will come to a place where we don't have enough money to pay a bill. When this happens, don't ignore it. Don't try and hide from it. Call the person that you owe money to and tell them what's going on and ask for help. 9 times out of 10, they're going to help you. Why? Because you owe them money and they want to help you pay it to them. Also, something about late payments. So making your payment on time is the best way to build credit, right? If you're late on a payment, it can hurt your credit score and your credit report very badly. But a late payment for your credit report and score has to be a payment made at least 30 days past the due date. Now, people have told me that they've gotten into trouble because they had a payment due and they didn't have the money, or they forgot to make the payment and they just went, oh, you know what? I'm not going to worry about it. I'll just wait till the next payment due date. Well, no, that's a bad idea, because by that time, it'll be a late payment. If you're a few days late, if you're 15 days late, you can still pay that payment and it's not going to affect your credit at all. Now, you might have a late payment charge, because when you make a payment late, You usually have an extra fee that you have to pay, but I'll tell you a secret. A lot of companies these days are refunding that fee the first time it happens. So what you do is this, you call up and you go, I'm so sorry. I made a late payment. This is what happened, and I'm really sorry, and I'm gonna make sure it doesn't happen again. Is there any way you can refund that fee? And you know what? They might do it, but they're not going to do it unless you ask. So ask. Okay, number 2, use your credit card as a credit building tool only. So a lot of the mistakes that people in older generations have made is they use credit cards and they pay them off over time, or they use credit card, they want to go on vacation, so they whip out the Visa card and they build up all this debt, and then all of this interest starts piling up and they can't pay it off. The best thing to do is not do that. The best thing to do is, if you want to take a vacation, save for it. If you want to buy a pair of fabulous boots, save for them. Use your credit card to build your credit by doing this. Buy one thing a month that you would normally buy anyway. It could be a tank of gas or groceries or whatever. When you get the bill, pay it off. And as you do this month over month, you're going to build good credit. Number 3, don't apply for cards or loans you do not need, especially 0% cards. So you may have already started getting things in the mail like you're pre-approved for 0% financing, blah, 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 blah. And what you may not notice on those pre-approvals is that after 12 months, your interest rate becomes 25%. Or if you're 2 seconds late on a payment, a penalty interest rate kicks in and it becomes 30%. And with interest rates like that, if you owe any money on those cards, a 25 to 30% interest rate makes it almost impossible to pay off that debt. Instead of doing that, just don't. If you're going to apply for a card, make sure it's a card that you're going to keep for a really long time, like forever. Okay, as I'm saying this, you also have to be aware that increasing your credit mix over time is an important thing to do. But if you have a student loan and you have a credit card, you're already there. You already have a credit mix. Now, when you start paying that student loan, that's going to start building your credit report and score too. But right now, use that credit card once a month, pay it off when you get the bill. Keep older credit cards open and active. And so as I showed you before, 15% of your credit score is your length of credit history. And here's what happens sometimes. You might have an old card that has, let's project you like 20 years in the future. And you have this credit card that you've had since college. And it's not really something that you want to hang on to. You've got some other credit cards that have lower interest rates. And you've got this card and it's like, I don't ever use this card. I'm just going to close that. Don't do it. That can interfere with your credit longevity and it can actually lower your score. Also, keep these cards active. So some people have a couple of credit cards, but they don't use them. And so they're not getting the benefit of an on-time monthly payment. That can hurt them. But also, if you don't use your credit cards after like 2 or 3 years, your credit card companies might close them because they think you're dead. So you have to make sure that they know you're alive by using those cards every month. I'll give you an example. I have a Macy's card. I've had that thing for 22 years. I use it once a year at Christmas when they have those bazonker sales. And I use my card. I get the bill and I pay the whole thing off. And that's it for the year. And so they don't close it. Okay, keep credit card balances at 30%, actually at less than 30% of the credit limit. Now that's not a cumulative thing, that's per card. So if you have 3 credit cards, make sure they're all, best thing to do is keep them at 0, pay them off every month. And if you have a couple of credit cards, make sure you're using one or the other every month and then paying them off when you get the bill so you can get that on-time monthly payment thing. Here's another one. When you open an account, set up text alerts to make sure you know when the payment is due, and also so you know when the payment has arrived. Sometimes we think we've made a payment and something happens with the technology and the payment isn't made the right way. And then we don't notice until we get a letter saying your payment is late. And that is truly terrible. So make sure that you not only know when your payment is due, but when it has been made as well. Also, every single month, review your credit card charges. In fact, don't wait till you get your monthly statement. If you have your credit card, access to your credit card on an app, use it and check it every few days to make sure everything's cool and that there's nothing on there that you don't know about. You can even set up text alerts to let you know when a new charge has come in. So you'll know if somebody has gotten a hold of your card and is using it. If you find an error on there, do not wait to report it. You only have a short period of time to report errors on your credit card account in order, and you have this short period of time where you can get the money back. If you wait too long, you may not be able to get the money back. One last thing, review your credit reports one time a year. And if you see any errors, correct them. It's called dispute. But you do that at annualcreditreport.com. Okay, here's another question that I got. How much does loan payment deferment affect your credit? It depends. It depends on the type of deferment agreement you've entered into. So right now, people who are paying on their student loans have deferred loan payments if their student loans are government loans. If they're private student loans or auto loans or credit cards or something like that, and they have deferred payments, it means a little something different. Let me show you what that looks like. There's another calculator that I want to show you. Back to here. Okay, back to Dinkytown. This is a deferred payment loan. So payment calculator. So let's say we owe $5,000, and let's say this is a student loan, a private student loan, and we're paying maybe 5.5%. So let's see. If we defer our payments for 30 days on this type of loan, what it means is we're taking the loan payment and we're taking it from now and we're tacking it on the end of the loan. What that does, and also if it's a private loan, a non-government subsidized loan, then the interest continues to accrue. So your loan amount is $5,000. Your starting loan amount is $5,022.92. That's with interest. That's when you've deferred that $22.92. That's 1 month of interest. Because you've deferred that 1 month, that $22.92 in interest is going to add up a little bit more. And let me show you this. And if you continue to make the loan payments on this, your total interest is going to be about $1,500 here. Now, if you defer for longer, let's say for 60 days, suddenly you're paying more interest. Here, let me show you this. So at 30 days, your total interest paid over the life of the loan is $1,518.65. If you go 90 days, it's increasing a little more. 60 days and then 90 days. So depending upon the loan you have and the arrangement you have for the deferment, it could mean nothing at all. If there's no interest that's accruing, then it's just like there's going to be an extra month of payment. If there's interest accruing on that loan, then it's going to cost you more. I hope that makes sense. Okay, so
We have another question. I don't know if you want to take questions right now.
Okay, and yes, actually, it's time for questions. So, what's the question?
The question is, what are the first steps to take to start building credit on your own, since generally you can't get approved for a credit card or loan without credit history?
I know that's so complicated anyway, and I'm so glad you asked because I have prepared that just for you. Okay, so let me show you something. Okay, so these are going to be resources that I'm going to post on this. One of them is cashcourse.org. I'm not going to go back to that. Let me show you something. So here's how to build credit when you don't have any. So what you can do, now this is kind of a catch-22. When you don't have credit, you can't get a loan, but in order to get a loan, you have to have credit, which is hard. But there's an answer to that. What you can do is apply for something called a secured credit card. Now, as a secured credit card, with a secured credit card, what you're doing is you're taking some of your own money and you're using it as a security deposit. And that becomes the credit limit. So let's say you put $500 in an account and your lender freezes it and makes that $500 into your credit limit. Then you can use your card to spend up to $500 a month, but you don't have to. And because you put up your own money as security, it's easy. It's an easier card to get. So once you get that card, use the card for one monthly purchase, pay off the card when you get the bill, keep doing that for 12 months. And then at the end of 12 months, reapply for that card, but ask them to remove the security so you have access to your $500. And then once you have that, once you've done that, I would suggest getting one more type of loan or credit card to start building your credit mix. And then, of course, always follow those 9 rules of good credit. Does that make sense? Another way to do that, another way to build credit when you don't have any, is ask a parent to co-sign on a loan with you. Now you have to be really, really careful, because when someone co-signs on a loan, they are equally responsible for what happens on that loan. So if you miss a payment, it affects your credit report and your parents. So be very careful. What other questions do you have?
We have a couple. The next one is, do you have any tips on getting into investing as a college student?
Oh, investing. Okay, so full disclosure, you have to have this special licensing to give advice on investing, and I don't have that. So I can't give you advice except from my own perspective, which is this is a really bad time to do that because we have a very volatile market because, you know, global pandemics do that. So if you want to know more about investing, there's a website called howthemarketworks.com. And it lets you practice and see what it's like. It's kind of, they give you a certain amount of fake money and you can pretend like you're investing it in real investments. It's kind of fun. But with investing, money you invest has no guarantee on it. So you can invest money for years and years and years and build up thousands of dollars. And then global pandemics happen and you lose everything. So you have to be really, really careful when you do that. Okay, another question.
The next question we have is, can you give a few quick definitions on lenders, collection agencies, and interest?
Yes. Okay, a lender is somebody who loans money. That can either be through for something physical like a car or a house, or it can be for something that's unsecured like a credit card. There are other types of lenders. There are payday lenders who allow you to borrow against your next paycheck. Those are, I'd stay away from those because they charge very high interest rates. Now, an interest rate is a fee that you pay for borrowing somebody else's money so that you can buy something. And the interest rate that you're charged depends on your credit score. So the higher your credit score, the lower your interest rate. And lower interest rates mean lower monthly payments, and the lower and a less credit, pardon me, less interest that you're going to have to pay over the entire term of the loan. A collection agency, when, let's say you have a loan and you can't pay it back. So your lender can try and collect that money from you, and they can call you and write you letters and take you to court and all these things, but that costs money, and sometimes they don't want to do that. So what they can do, what some do is they sell unpaid accounts to a collection agency. And the collection agency, let's say that loan that you got was $5,000, the collection agency might pay half for that. So they pay $2,500 for your $5,000 loan. But by doing that, they're allowed to collect the full amount, even though they didn't pay that much. That's how they make their money. And of course, if they pay $2,500 and they collect eventually $3,000 from you, then they've made some money. What happens when an unpaid loan goes to a collection agency is you get harassed. They will call you and call you and call you and call all your friends and call all your relatives and find you and call you some more until you agree to pay them. And it's a drag. So if you can avoid that, avoid it. Yes. Okay. Other questions. Let's see. I heard that you have money and owe collections. You can bargain and pay less than you actually owe. How does this work? And what are successful ways to do so? Okay. So that collection agency bought your loan for $2,500 and they want you to pay $5,000. And you say, look, it's never going to happen. I don't have that kind of money. I'm going to pay $3,000. And the collection agency says yes. So what happens is they collect that $3,000 and the extra $2,000 that you owed on the original loan is forgiven. Kind of. So you don't have to pay that money, but in January of the following year, you are going to get a form that shows that that $2,000 you didn't have to pay is taxable income. And then you have to pay taxes on that. So is there a successful way to do it? No. Because what it does to you also is if you have an unpaid debt and you make a bargain and so you have forgiven debt, that appears on your credit report for 7 years, and it's going to interfere with your ability to do things, because it's going to make people who are making decisions about you stop and say, ooh, wait a minute, they don't pay their debts. I don't know if I want to take the risk. So you may hear commercials saying, we can cut your debt in half. Don't go there, because you may have to pay less now, but it'll hurt you in the future. Are there any other questions? Well, I want to thank you all today for having me to this. I will make sure that you get a copy of all the slides that I've had. And if you have any questions, my email is on the documents that you will get. And if you'd like, send me an email, ask me your questions. I'll be happy to help you. I do not charge for doing this. It is my job. I get paid to teach people this stuff. And because somebody else pays me, I don't have to charge you. So thank you very much for your time.
Thank you so much. This is really helpful.
Did that help?
Yeah, this is awesome. Thank you.
Oh, good. All right. Actually, Erin, Ashley, and where's Annika? Can you guys stay? And I have some questions for you. Yeah. Everybody else, goodbye. Thank you. Johnny, thanks for coming. So could you tell I was really nervous?
You're so good. Oh my gosh.
Was that good? Was that okay?
Yes.
I felt my lips weren't working. I was stumbling over my